All right, perfect. Yes. So let's start with the first educational content concept-wise video. Now, before we actually get started, I need to address three things. First thing being that if you have not watched both intro videos, so that is the intro video of the mentorship itself, and that is the intro video of the house rules. So the new enrollment intro video, which is above this video. That is very important. Otherwise, everything we are doing here can be actually seen as useless if you do not understand those house rules and that intro video. That's very important. Then the second thing is that if anything doesn't make sense right now, then that's okay. That is perfectly fine. It probably will later on. So the way you can see this, the way you can view this mentorship, it's truly like a book. It's a TV show where the plot twist at the end of the TV show doesn't make sense at the beginning of the TV show. So with every video that we go by, that we go over, the story makes a lot more sense. So we build onto every previous video. We build onto the story. The story doesn't all of a sudden start all over again. No, we build onto the previous story. That is very important to understand. So at the beginning, it might be a little bit vague. Over time, over a period of time, it will make a lot more sense. Very important. Then the last thing before we actually dive into it is that these videos are not edited. And the reason for that is because you might expect a lot of edited videos here on the mentorship, which is just not the case. And the reason for that is because I don't want to distract you with anything, and I need you to understand my full thought process behind things. Very important. Then we can dive in. So the story starts here. All right, now the story starts with PD arrays, premium and discount arrays. I already assume right here that you have some basic knowledge on certain PD arrays. Doesn't have to be advanced, extreme knowledge, just basic knowledge of PD arrays. So these PD arrays are very important. And the reason why we start with them is because these are the foundation. They create the foundation of your trading. So if we state them and we state the foundational levels, that if you understand these foundational levels, you can be a profitable trader. And when I say you need to understand these foundational levels, I mean that I can ask you a question about any of these foundational levels and you fully understand why you're using it, where you're using it, when you're using it, all those things. So let's start off with the first foundational level. The first foundational level is bias. So let me write that down. Bias. That's the first foundational level of trading. Then the second level is narrative. Then the third level is boundary. That boundary is in brackets context right there. Why is that context? Again, that will make a lot more sense in a later video. So in one of the next videos, that will make a lot more sense on why that is boundary, why that is context, etc. Then also a part of that is a target. So that is the next foundational level, and that is also part of your context. So the boundary and a target are what we call a context. That context will make a lot more sense again later on. Then the next thing is entry pattern. That's the next foundational level that we need to understand in order to get to a trade ID. Then the last thing is risk management. Now, these are the foundational levels. These foundational levels are there to guide you. If you can understand those, they are there to guide you to a profitable trade ID. So once you get to a profitable trade ID, the way you can get there is through foundational levels. So if we understand bias, all right, on to the next one. Narrative, we understand it. All right, on to the boundary, we understand it. All right, onto the target. We understand it. Perfect. Entry pattern, then the risk management. That leads to a profitable trade ID. Of course, we will also take losses, so this can also lead sometimes to an unprofitable trade ID. It is what it is. Overall, over a longer period of time, we will be profitable. Now, right here, these are the things that lead you to that trade ID. And the reason why I emphasize on that so much is because this is extremely important to understand. The basics is what we want to master. And this is what we need to understand in order for us to actually get to a trading plan, because a lot of people don't know where to start. This is where you start. And again, above these foundational levels, you can understand them by understanding the PD arrays. So the PD arrays, they are there to create the story of price. So these foundation levels are all the things you need to successfully trade. They create the story of price. So what are the PD arrays that we need to actually understand? Well, the first PD array that we actually need to understand is a breaker block. Then the second one is a mitigation block. Then we have an order block. Then we have swing points. And when I say swing points, I'm referring to a swing high and a swing low. So then the fifth one is a previous X low or previous X high, and a previous X low. What I mean with this is this can be a previous month's high, previous month's low, can be a previous week's high, can be a previous week's low. Any candle on any time frame you can think of. And when I'm referring to any time frame, I'm referring to the time frames that we have in the top left, which we'll dive into more as well later on in a different video. So previous X high can be previous day low, can also be 4 hour, previous 4 hour candle high, previous 4 hour candle low. This is not a newly added, but if you've watched previous enrollments, so for the members that have already been here before, then you know that this is added sort of quote unquote new. And the reason for that is because this is part of context usually, and part of a target, part of a boundary, part of an intermediate term high, intermediate term low. Now, what I just said about the context boundary, that won't make sense if this is your first time watching this and if this is your first enrollment. So don't worry, that will make a lot of sense later on. So the last one is, of course, fair value gaps, the beauty of it all. Now, right here, we need to understand these different PD arrays and why we use them and how we use them. So every PD array has a different function in the market. The way the market functions is the market either delivers towards fair value or is taking some kind of liquidity. That probably won't make a lot of sense right now, but that is how the market functions overall. That is a general rule of thumb that we use on how the market functions. That will make a lot more sense once I explain the different PD arrays. So let's start off with a breaker. Because when we move from a leg lower, so when I refer to a leg, it's just one leg lower. Very visually, how can we see the legs right here? We have one leg lower, one leg higher, one leg lower. So when I refer to a leg, then this is basically the leg lower that I'm currently referring to. So this leg lower right there, this is the current leg that I'm referring to. That leg lower has a different PD array every single time in the different grades of that leg. What I mean by that is that a leg starts off with a breaker block. Then there is a mitigation block. Then there is an order block. In between them, there are swing points, previous X high, previous X low, fair value gaps, etc. But the first three, they are in the right order. So right here, the first reversal point is always a breaker block. That's always what we want to ideally use, a breaker block. Again, a breaker block, how can we visually see it? It's just very simply following the lines, following the legs that we just mentioned, and then the last leg higher right there gets violated, and that turns into a bearish leg. Then that bearish leg creates this last down move before the up move right there, creates the breaker block. So again, I already assume you have some kind of previous knowledge on PD arrays. I'll still touch on it right here on how I view them, what the actual breaker is, but I still assume that. So right here, we can see that we are moving higher overall. Now, where the reversal, etc. happens currently, all things that currently is not relevant. That's things we will go into. So again, remember the stories part that we talked about. We have this move higher. Then that move higher creates this swing high that is sitting right there, this swing high. That swing high creates a move lower. That swing high creates this swing low, which is just, again, we just move higher. So we're overall just moving higher right there. Now this swing high is important right now. Only after the fact. At this moment in time, once we're just moving higher, it's really not that important. Because again, right now we would just expect higher prices, right? Overall, just very basic, looking at where's price going, is moving higher. All right, perfect. Then we have this swing low right there. So we have this last down move before this up move. Once we violate that, or we start to violate that, then this whole area, once we start disrespecting everything that is in the bullish side right here in this gray area, disrespecting might not make sense right now, will make sense later on in a different video. Once we start disrespecting that, and as a general rule of thumb, once we start delivering below this low, below that swing low, that is when we have a breaker. This breaker right now is what you can just simply see as a resistance area. It's where you would expect lower prices from. So this is where, this is the first PD rate, this is the first premium array, because again, a premium array is when we're looking at bearish prices, we're looking at premium arrays. When we're looking at bullish prices, we're looking at discount arrays. So this right there is our premium array that we are expecting lower prices from. That is our breaker block. Now, after that, we deliver lower, and then after that, we create a mitigation block. The mitigation block is actually this full up move right there. So the way I want you to see a mitigation block is, again, very simply looking at the overall structure. And I don't really mean current market structure. I just mean the overall structure of how the market is presenting. So almost as if you're looking at a line chart. So if you were to put on a line chart, this is exactly how I want you to view the current market. And the reason for that is, again, and we can get more specific with that overall later on as well, is because it makes the PD rays a lot more easier to visualize, especially the breaker block and the mitigation block. Once we are diving into order block, swing points, previous X high, previous X low, fair value gaps, it's a different story. But for breaker blocks and mitigation block, you can almost use the line chart right there to view them. So what I mean with a mitigation block comes after a breaker block. So we first have a breaker block. Now again, the order of this is good to know. Will it be super relevant later on in the story, in the overall story of this mentorship? Not really. So don't force the ID, because I can already see it happening, that don't force the ID that there absolutely needs to be a clear breaker block before we get a mitigation block. Otherwise, RU set is not valid. No, don't do that. So if there is a breaker block, just visually, all right, there's some kind of a breaker block and we have mitigation block, perfect. As general rule of thumb, they go in the right order. That's important. Now, a mitigation block is just the last leg higher before we move lower. If it's a bearish mitigation block, so a premium array again. The way I visually want you to see this is that we have this breaker that is being created right there. Then we have a move higher back into the breaker or whatever it is right there. And then we follow through lower. So essentially what the mitigation block itself is a move lower, move higher, move lower. This creates a mitigation block. So every move lower right there creates what? A new mitigation block overall. Now, that is very similar to an actual order block. There's only a slight difference. Where the breaker block can only happen once right here. The breaker block happens at the beginning of the reversal, at the first reversal area. That's your breaker block. Everything afterwards is a mitigation block or an order block. So a mitigation block is where we can have any candle on the upside right there. So if we're bearish, we're waiting for a premium ray. These up candles right there you're seeing can also have a down candle in the middle of them, where an order block can only have consecutive up candles for a bearish order block. So what does that look like? Well, if we skip price a little bit, then we see these two up candles that we have right there. That is not a mitigation block. Why not? Because it's two consecutive up candles. If it was two consecutive up candles or not consecutive, and there was within those two up candles, in between them, there was a down candle, that low would have been considered a mitigation block right there instead of an order block. So you can see the difference where these are two up candles. Doesn't have to be two, as long as it's up candles. These right there are not consecutive, not all of them are consecutive up candles before we get the down move overall. So that is considered a mitigation block. Now, these two candles at the top right there, you can probably tell the difference right now. That is an order block right there. But overall, if we already have this, then you don't need to redefine it. You don't need to refine this to a mitigation block. And inside that mitigation block, we have this order block right there. It's not necessary to do. So that is a breaker block, mitigation block, order block. Again, if that doesn't make a lot of sense right now, perfectly fine. It will make a lot of sense later on. So right now, we follow through on price. So we continue lower and we are creating more order blocks. That is quite important to understand because within a bigger mitigation block, from a bigger mitigation block to another mitigation block, we are creating order blocks. So what I mean by that is we just went over this structure, which creates the mitigation block right there, right? Then this right here does what? This creates your mitigation block right there at these lows to then continue lower. In between this delivery, what can we see? We can see order blocks right there, hold. Order blocks right there, hold to deliver lower. And then right here in this new leg lower, order blocks right there, hold. Order blocks right there, hold. Order blocks right there, hold. Why am I telling you this? Because that might sound a little bit vague. It's because mitigation block and order block are basically the same exact thing. And I just mentioned to you, but you just said these consecutive up candles, down candles, etc. makes a difference between order block, a breaker block, mitigation block, sorry. Yes, that is true. But if I were to zoom out on one singular time frame on this mitigation block in that gray area right there. So we remove the order block, breaker block to make it visually more clear. If I were to zoom out right there, then what happens? That becomes what? An order block. So it's only relative, which leads me to the next exact point that a breaker block, a mitigation block, and an order block are there for fair value purposes and trap purposes only. That again is where we now need to dive into the swing points, previous X high, previous X low, fair value gaps to fully be able to understand that. Now, that is again, hopefully that is clear that a mitigation block and order block is all relatively seen to whichever time frame you are looking at overall. It's as long as you understand that those are functioning as fair value. So next part is where we have swing points. So swing points, again, we don't need to overcomplicate this. This is where we have the swing highs. So the swing highs, again, that 3 candle pattern where we have a wick sticking out at the top and a lower wick to the left of it, lower wick to the right of it right there. That creates a swing point. So of course, a swing low right there is the exact same, just vice versa, where we have a wick lower to the left of it, higher to the left of it and higher to the right of it. Swing low, perfect. So these are swing highs right there. Swing highs are also PD rays, and they are also very important in how we interpret price action. And they will come in very handy later on. They are known as liquidity pools. So with liquidity pools, what I mean with liquidity pools, liquidity is basically other market participants. Now that's not us. We are not really liquidity. As in, yes, we are liquidity. We are not the target of liquidity. So you might already be familiar with the story of there's an algorithm and they target liquidity, etc. Yes, again, do I fully know the truth? I would be lying to you if I said, yes, I fully know the truth. And I don't think anyone knows the full truth. But if that makes you comfortable to believe that, then let's add on to that idea, because it makes me comfortable to believe that. And it makes the strategy a lot easier to comprehend. So with liquidity, we talk about swing highs and swing lows. They are liquidity points. That liquidity needs to be taken out for certain market orders to get filled on the other side. Again, this will make a lot more sense later on in this video. Now, previous X high and previous X low. That is very simple. You have a candle. For example, the most recent candle right here on this Wednesday, 15th of November, right there, the most recent candle. The high of that candle is a previous 1 hour candle high right now. And the low of that candle is the previous 1 hour candle low right there. This will also make more sense later on. You just need to understand that this can either be a target and a boundary to go into the lower time frame as well. So all these PD rays, again, are referring to the foundational levels. That is important. They are telling you a certain story of price action to get to a trade ID. So the previous X high, previous X low is just the last candle, previous day high, previous day low, previous week's high, previous week's low, previous month's high, previous month's low. They are, again, liquidity points. That is a liquidity point, because on the lower time frame, what is that? On the lower time frame, that is a swing point. So for example, on the 15-minute, that right there creates what? That swing point, a swing high right there. So the next thing is a fair value gap. Now, the fair value gap is arguably the most important one. Why? The fair value gap, if you're not familiar with it, and I do think you are familiar with it, is a 3-candle pattern. It's important to understand that I say 3-candle pattern for a reason, because that will make a lot more sense later on in the mentorship as well. Where right there, the 3-candle pattern is 1, 2, 3. So we have this candle right there, then we have this candle right there, and then we have this candle. Once that candle closes, it creates this gap right there. That gap, why is that a gap? Because there is no space, or sorry, there is actual space. If there was no space, then the wick would have filled it like this, and that means there was no fair value gap right there. That fair value gap, and you can already tell by its name, is fair value. So when we have a fair value gap, you can also refer to it as an imbalance in price action. It's where price was not delivered fair value. So the market, the way it functions is, and what I mentioned is the way the market functions is fair value and liquidity. So liquidity, as in we need liquidity, we need market participants to actually move the price. So huge institutions move the price, but also huge institutions get taken out. So for example, there are 10,000 lots that can move the price action. They get taken out to then get filled by another huge institution that is a little bit stronger, that took their liquidity to then move the price action in their preferred destination. Then to keep the market fair and to keep the market sort of in balance, there is fair value gaps. So if we only have a bearish delivery right there, then that creates one-sided delivery, one-sided price action. Now, only bearish people, so only bearish market participants right there had the chance to get involved. So in order to create a fair value of price, in order to also say, hey, okay, we also need some buyers to offer fair value, to also give them a potential chance to get involved. We need to retrace back into those imbalances, which are the fair value gaps, to offer a fair value to bullish market participants, to also let them potentially give them the opportunity to get involved. That is very important to understand. Again, the full mechanics behind it, etc. Do you need to understand them 100% detailed? No, absolutely not. But it will make the why and why we do things right here and how we do things, it will make a lot more sense. So overall, this doesn't make a lot of sense. Then maybe come back later on inside the mentorship, inside this enrollment. Once you've already finished the enrollment, for example, then this will probably make a lot more sense as well. Now, that is important to understand about fair value gaps. And it's the same for the bullish side. So once we have bullish price action right there, then there were only bullish market participants. So only bullish market participants got the chance to get involved. Is that very fair? No, so it's not very fair value. So right there, we also need to give the chance to bearish market participants to potentially get involved. All right, they had the chance. Now we can continue higher. Now, that is important to understand. The reason why is because that leads me to the next point, which is liquidity plus fair value for a breaker block. So a breaker block consists of liquidity plus fair value. Then the mitigation block consists of fair value points. That is the same for an order block right there. That also consists of fair value. I just mentioned to you that the market is either offering fair value or it's grabbing liquidity or taking liquidity or doing whatever it wants, right? So it's either doing one or two things, fair value or liquidity, fair value or liquidity. That is important to understand. Overall, that again doesn't make a lot of sense. It will later on. Then we have swing points. Swing points are there for liquidity. Can also be fair value, but I just refer to the swing points as a swing highs, swing lows right there to see if liquidity gets taken out of the market. Then we have previous X high, previous X low. That also refers to liquidity. And then we have fair value gaps. That refers to, of course, it's already in the name, fair value. Now, why is that important to understand and why have I marked out those things? That is because the way we use these different break blocks, mitigation blocks, order blocks, the different PD rays can be very much simplified. If you know me, and I hate the discussion, and it's a futile discussion on people that try to discuss, that's a break block, that's a mitigation block. No, it's an order block. It's futile. And if you discuss like that, be my guest, you're wasting your energy. But you don't really understand how the market moves if you discuss that. And the reason for that is because, again, the market moves from liquidity to fair value. So it's only liquidity and fair value. So it's constantly either taking liquidity or it's offering fair value. That's the only thing the market is doing. So if we understand that and we place the mitigation block and an order block in the same category, then the mitigation block and the order block, like I already mentioned with the time frame example, are basically the exact same thing. The only thing it is support and resistance, the way we see it. And again, I don't mean the random lines you draw, but that is the way you can view it. It's fair value. It's a fair value level, a fair value level of support or resistance. Then the same can be said about a breaker block. But a breaker block is not necessarily fair value. It's more so a liquidity story because it takes liquidity before it moves the opposite way. Then for a swing point is again also a liquidity. Previous X high, previous X low, also liquidity. Fair value gaps, also liquidity. So again, the discussion of something being an order block, a breaker block, mitigation block is very futile and it's extremely almost stupid, I would call it. Because if you argue about that, then you just don't really understand how the market functions in itself. The names are just there to make you more comfortable. When people are learning new things, it's easier to label certain things because it will make a lot more sense on why it is that, on what it is exactly. If I just tell you it's fair value, then okay, it might make sense. But if I tell you it's a mitigation block, okay, that makes a lot of sense. So that is quite important to understand. And it's the same for an order block, etc. So again, it's easier to give something a name instead of just saying it's support and resistance, for example. Now, these liquidity and these fair value things, so the two things that makes the market move, they are telling us, through the PD rays as well, where price has no reason to return back to. As in, where was fair value already in the market and where are people trapped that shouldn't be released? So if we tell the full story, then the full story here for a liquidity wise is that right here, if we understand that people are getting trapped through liquidity, is that right there, this high, that high is where people, huge institutions, have their breakout order. As in, there's a buy stop above that high right there before the market reverses potentially, which they don't know, of course. So the way they view the market is through this lens right there, where they place their stop loss, potentially lows like this, most recent swing lows, which is why those swing lows, those swing points are liquidity because they are stop losses, but they are also new orders. So this new order right there is above that swing high, which is a breakout order. It's a buy stop. So once it reaches above that high, there's an activation in the order, and that order activates to then continue higher to target higher prices. In the idea of if this is already moving above that high, then it should continue higher, right? Overall, because it's already showing bullish intention. After the fact, we create something like this. Now, what do you see if you look at this position tool? You see that price action here, or the price action is below our entry level. So our entry level right there, we are overall in drawdown. Now, if we understand liquidity and we want to trap these traders in order to feed our own pockets, that's what huge institutions, financial institutions think. We need to let someone else bleed to make our own bread. Right there, we need to let them sort of suffocate. We need to keep them suffocated in order for us to make profits. So we take a counter sell. And with we, I mean, for example, financial institutions. Again, this, if you don't fully understand this, it's okay as long as you understand the PDRAs that we use right here. Now, right here, the story on why we use this breaker block is because right now people are trapped right there. So ideally, where are the entries of those people above that high, which is the breaker block high? So ideally, we don't want to come back above that high right there, which we do. Why do we do that? Pay attention, because that will make a lot more sense later on. And then the next part is, all right, people are now trapped. Well, okay, perfect. Well, we have now had this huge move lower. We need to also, with that fair value gap, offer some fair value. So that is where the fair value comes into play, and we return back to that to then continue lower, which creates what? This mitigation block right there. That mitigation block is marked out by this low right there. That low is where price is now in fair value. Because again, the whole story we just mentioned of we are moving lower right there, and we only had sell side participants, we only had bearish participants, we need to offer some bullish participants as well. All right, perfect. How can we do that? Well, we can see that through fair value gaps. Also mitigation blocks, because mitigation blocks right there creates what? Well, we had this this sell leg right there. So sell side participants were able to short the market. We didn't really get buy opportunities. All right, so we offer some buy side to the market as well. Perfect. Then after that, we have offered sell side and buy side. So everything below this low right there is what? It's not fair value yet. So everything above that low is already fair value. So there's no reason for price to retrace far back above this mitigation block low right there. And that is where we then continue lower. And it's the same story for after we create that new order block, which is again, can just be seen as a fair value area. Because right here, we have this this move lower, which again is a sell side, which we mentioned. All right, everything below this area, below that low, there are only sell side participants in the market right there. Let's offer some buy side. That buy side gets offered right there, and even more refined a little bit right there to make it easier to understand the story. So this right there is where we had the retracement. All right, so this is where we had the sell side to the buy side right there. So everything below this low is not fair value. And everything above it right there is already fair value. So again, there's no real reason to then continue higher. So that is very important to understand about fair value. And that continues and continues. It's the same with this right there, where we have this move higher. And then we have this, everything below this. And that is why we see this wick, because that is where the fair value was. And then we do the same exact thing right there and right there. And we just keep on continue doing that. And that is also why we saw this overall bigger retracement, because we already had this move lower, the move higher, sell side is offered, buy side is offered. We get only sell side. So everything above this low right there is what? It's not fair value. Everything above it is already fair value. That is why we have the retracement right there to then continue lower overall. Now, that is the story on fair value. And that is also the story on where people are getting trapped, because above those swing highs and swing lows, people are getting trapped, like we saw with the breaker example right there. If we don't want to release people, like we mentioned right there, then we should not come back far above this high. If we have a fair value gap, then of course, that is a different story, which leads me to the next point, that if we have fair value gaps, then you can probably tell that the fair value gaps told us almost everything that we needed to know right there. Because every mitigation block and order block and breaker block was not relevant without the fair value gaps. Every PD array, the breaker block, mitigation block, and the order block needs to have a fair value gap. If it doesn't have that, it's not a PD array that we are going to use. This is extremely important to understand. So the reason why I use this breaker block right there, because I had a fair value gap right there. So it's overlapping with the breaker block. The reason why I use this mitigation block is because it had a fair value gap right there. That is why I use that mitigation block, and that's why it's a valid mitigation block. The reason why I use this order block is because it had a fair value gap overlapping right there. Now, why did I use the low right there of that wick on that order block, and why did I use the body right there of that mitigation block? If the point, so the exact low of the candle, which creates the PD array, so in this case, it's the order block right there. That is the low of the PD array. That is when you want to see if it's overlapping with a fair value gap. If the exact wick low, so the exact smallest point right there, the exact tip right there, is overlapping with the fair value gap. So there's a fair value gap right next to it, or at least this area right there leads into a fair value gap right there. Then you use the wick, the low of the wick. Why is that? Because that leads me back to the same story of fair value. Because this low is beneath that low, we didn't offer a fair value yet. And above it, we already did. So this area is the fair value area right there. Which, if we take it a step back and we go to the mitigation block, then we can also see this low. Is that overlapping with a fair value gap? No. So this right there, this area is where price will refer to, because this area already, you could see it as, is already mitigated. So that body of the candle is what you would want to use in that situation right there. So again, these PD arrays are there to tell you the foundational story of price. These PD arrays are there for the foundational levels. And the reason why I went so in depth on the liquidity and the fair value is because if we are not trapping people and we are releasing people, for example, above this high right there, then that tells us a lot, right? That tells us where price potentially wants to trade towards next. If we already know that there was already fair value in this area right there, so we should not come back above very high, then we already know if we do come back very high right there, that tells us that we want to trade in the opposite way, most likely. So let me show you that example, that if we do that, and we can see that right here, that overall, we have now created what? We have created this mitigation block. Move lower, move higher. Nice. So this low, overlapping with the fair value gap, creates what? A mitigation block. So this is the area where you would, at maximum, expect lower prices from. If that doesn't happen right there, then now we have already offered fair value right there. So what is price doing there? It's doing nothing else but seeking liquidity right now, because we've already offered fair value. And again, if we are not offering fair value, we are taking liquidity. If we are not taking liquidity, we are offering fair value. So again, the market is doing one of two things: liquidity, fair value, liquidity, fair value, fair value, liquidity, fair value, liquidity. Either one of those two things. So right here, now what would you do? Okay, this is interesting, because right now there's no reason to come back above, because all this below this was considered not fair value. Everything above that low is already fair value. So there's no reason to come back above it very far. Maybe a sting into it, nothing more than that. So now the target would be, all right, well, what is the liquidity? The liquidity is these highs right there, which then overall does what? That creates then eventually your new potential breaker block. Now, again, if this doesn't make a lot of sense right now, then it is perfectly fine. It will make a lot more sense, hopefully, later on in mentorship. I can guarantee you that definitely. The thing I need you to understand from this video is why we use them for liquidity and fair value purposes. The next thing is where to use them, what are they, what to mark out, the overlapping part, and what makes it a valid PD array. Because for every valid PD array right there, we needed to have a fair value gap. That was the most important part. If you can understand those questions again, then you are doing absolutely perfect. And as well, understanding that we are not using any more PD arrays than the PD arrays that we have right here. So this is all the PD arrays that we use: breaker block, mitigation block, order block, swing points, previous X high, previous X low, fair value gaps. That's the only thing we use right here. And how we use them, etc. Because certain previous X high, previous X low, we've not really gone into. But that is something in a different concept, combined with a different concept, we will eventually go into. Take your time studying this, because already in the first video, there's a lot of information to take in. And in the next video, we will, of course, build onto this idea, which will make it a lot more sense, of course. All right, perfect. Thank you.